Hi guys, welcome to chapter 1 video. We're going to do an introduction to taxes and the basic tax calculation, as well as a few other topics at the end of the chapter. So the first concept, and I go over this in the problems for this chapter and the video going over those problems again, but the tax types. So there's fundamental tax types that I'll cover and you'll learn about in this chapter. Marginal versus average tax rates and what those two are and what the difference is. We'll do the simple income tax formula. So basically, most tax calculations are simple. And the way you learn about income taxes is basically starting with a basic return and then adding more complications and more concepts with each chapter as we work forward, versus covering one section at a time and not putting it all together until the very end. So we are not doing that. Instead, we're starting out from the very beginning, doing the entire return, but it's very simple and we just add pieces in as we go forward. And honestly, income tax could be multiple courses. People get master degrees in income tax. So you're going to get a good feel and you're going to learn a lot in this class. But it's not going to be, end all master of taxes. It's just not the nature of, taxes. So I want to specifically go over the tax refund or payment due concept, which is often confusing for people. And then we'll just look at the appendices. There's the tax authority. I'll talk a little about that. Rules for paid preparers. So paid preparers means that someone's being paid to prepare a tax return. Appendix C is getting started with the Tax Act software, so you can refer to this when you're going through the forum assignment. Okay, so the types of taxes are three main types: progressive and proportional and regressive. So progressive just means that, like it sounds, progress, it's increasing. So that would mean that the tax percentage gets bigger as the base, as we call it, income amount, the amount that you're timesing by the tax rate, increases. A proportional tax system is one that stays the same. So that's typically called a flat tax. I'm very in favor of a flat tax. So just a flat 5%, everyone pays 5%. Now, Medicare is actually an example of a flat tax. So 2.9% total is what the Medicare flat tax is, with employees paying 1.45%. So if you look at a pay stub from your employer, you'll see the Medicare amount withheld. And if you look at the amount of your check and you times it by 1.45%, that's the amount that should be withheld. So you can literally check it. Now, your employer is actually paying the other half of that Medicare tax for you, which is how 2.9 is the total amount that's credited to you, but your employer's splitting it. So with the regressive tax, that means that the percent gets smaller the bigger the base. And essentially, we do in many respects have a regressive system in spite of our tax brackets because, I started working in public accounting, so the only individual returns we did were extremely high net worth individuals with multi-millions of dollars of income on their returns. And typically, I never saw an average rate over 10%. And, most middle class and lower middle class tax returns, people are paying upwards of 15 to 25% just basic, let alone when you get to upper middle class where it's really more like 30%. So regardless, regressive, so that's why Social Security is not exactly a clean example, but it is a regressive tax because Social Security tax only applies on the first 120,000 of earnings. Once you reach a threshold amount, you no longer have to pay Social Security. Until you make that amount, it's a flat tax, proportionate, just like Medicare. But once you make 200,000, that's the base, and the percent of the tax is only 7.65 of the limit, the 120,000. It goes up a little bit every year. So the amount of tax paid stays the same when they made 130, 140,000, 150,000, but when you keep dividing that tax by the base, as the base gets bigger, that percentage that income tax is going to go down. All right, so those are the three types. So marginal versus average tax rates. So marginal is the percentage of tax that applies to that portion of income regardless of how much money you make. So in our income tax system, sometimes people will say, oh, if I earn more money, it's not worth it because I'm going to pay more tax. But that is never true in our system because we use what's called marginal rates and brackets. So essentially, on the first 10,000 of income, everyone pays 10%. It doesn't matter if you made $70 million last year. On your first 10,000 of income, you pay 10%, just like someone who made $8,000. So you both paid the same on that first 10,000. Or someone that paid 100,000. And then the second bracket applies to everyone in the second bracket, and it continues to go up. So we compare that to the average, which was what I just explained in the regressive example for Social Security tax. You take the total amount of tax and you divide it by the total amount of income. That's what I meant when I said that when I worked in public accounting, I saw high net individuals and they were always paying their effective tax rate was always much lower. Now, effective and average are a similar concept. Add up all the tax, divide it by all the income. So the simple income tax formula that we'll be starting with in Chapter 1, and I have a video going over the tax return assignment, considers the following formula. And you'll see this on the tax return as well. So it starts with filing status, which you'll learn about in the next chapter. But essentially there's single, married, filing joint, married, filing separate, which is only used in extreme situations, and head of household and qualifying widower, which are usually the same. Or qualifying widower is the same as married, filing joint. Most people fall under single or married filing joint. It's based on your status as of the last day of the tax year. That's it. If you got married on 12/31/2018, then your filing status is married filing joint for 2018. So then you need to look at taxable income and all of the rules that apply to income. Now, the general rule is that all income is taxable unless there's a rule that specifically excludes it. And usually that involves some sort of calculation. Then we have deductions for AGI. And those are specific amounts we get to deduct from these income amounts. Now, the concept of AGI was really based on our old tax return, which has been updated because of the December 2017 Tax Cuts and Jobs Act. And you'll see another video in this section where I go over the old return and the new return and how to find the new returns and explore the IRS website, which is good to know how to do. So you'll see the concept of adjusted gross income in that video explained more, but essentially it's a subtotal on the return that is used to base many different limitations and calculations on. While we're going through the simple formula, the tax formula can be far more complicated. And basically every income item, every deduction, every situation has a calculation and rules that apply to it. So then comes the standard or the itemized deduction. Now, this is basically everyone gets one of these deductions, whichever is more. Most people take the standard deduction, but some people can take the itemized deduction. Then you're down to taxable income. So you get to AGI, deductions for AGI, that equals AGI. Income minus deductions for AGI equals AGI minus standard or itemized deduction, that equals taxable income. Then you calculate income taxes and then any other taxes that might apply. Sometimes self-employment tax. If you have self-employment income, we won't get into that though in this class. Then payments. You can take the 137 business tax, which will cover self-employment because that's technically a business. Payments are any amounts that were made throughout the year as estimates for your taxes. So your W-2, Box 2, federal income tax withheld, those are considered payments throughout the year for your taxes. So the difference between the income tax calculated on your return based on taxable income minus the payments you've made throughout the year equals a refund or a payment due. Now, that refund or payment due, a lot of times people get confused and they think that, oh, I owed money this year. What? That's so horrible. I must have paid more in taxes. Well, that's not what that means, right? Because the payments you make throughout the year are just an estimate. If you changed jobs or there was a mistake and you didn't have income tax withheld or nearly the amount you needed, then you might not have paid in as much as you did last year. So people feel it a lot more when it's not being withheld from their paychecks on a continuous basis accurately. Okay, so the Appendix A is tax authority. So it's really good to understand how taxes work. The IRS is under the U.S. Treasury Department. It's the Internal Revenue Service. The IRS has no opinion of their own. The IRS works for Congress, essentially. They're a department under the U.S. Treasury, but just like the U.S. Treasury, they work for the government, which includes all the branches of government. And they basically follow the Internal Revenue Code, IRC. So you'll be seeing that throughout the textbook. Now, the IRS gets their rules from bills, and bills typically come up in the Ways and Means Committee of the House of Representatives or the Senate Finance Committee. It has to pass in the House, and then the Senate has to bring it up for approval, and they have to pass it, and then the president can veto it. And it can follow the normal process from there. So then the IRS basically takes the bill from the House and they try to interpret it and create instructions and forms, and they apply it. And however, they do not nearly account for all the situations that people come up with, especially since we have a system that encourages what's called avoidance, non-illegal avoidance. So as long as you're playing within the rules, it's good to pay less tax. Instead of it being like a contribution, just like people like to contribute to something, instead of it being something people are proud about and therefore they're not trying to evade taxes, then it would just be a different approach. But because people have this mentality, it becomes, our system has responded in a way that's very cumbersome. And that's why you pay tax pros, because the rules have become so complex, because they're constantly trying to basically respond to people trying to pay less taxes and moving their monies in such a way that they can pay less tax while technically following the rules. And it's really that entire mindset, like that entire tone at the top, that creates the type of system we have. So tax professionals use all sorts of resources just to apply the law to complex situations, and even just some common situations that the IRS hasn't been incredibly clear on because they are backed up on different things. So, for example, there certainly is guidance, but newer industries, it tends to take a while for the IRS to start really clarifying some of the rules. So anyways, legislative regulations, you can read through Appendix A. Legislative regulations is what the IRS writes in response to Congress. And then there are temporary or proposed regs when nothing else is finalized, or to interpret legislative regulations. And then there's revenue rulings and revenue procedures which the IRS uses to clarify and instruct. And then there's tax court. And, if the IRS basically audits a return and says that they owe money for something, that person can, file against them against the IRS in tax court to say, hey, no, this is correct because of X, Y, and Z. Now, also, the IRS can take taxpayers to tax court. So there are all these different levels of resources. The outcomes of tax court cases are also a heavy type of resource for tax preparers to base application of the tax rules on when they're interpreting them. But for most tax returns, it doesn't, most tax returns aren't all that complicated, although there are often, various issues here and there. So tax preparers is Appendix B. In the past, anyone could do taxes, but there was a real prone to rip people off because because people want to save taxes, right? And so tax preparers can say, oh, I'll save you taxes and they'll do certain stuff. So anyone you pay to prepare a tax, which is what it's called, prepare a tax return, PTIN, is a paid tax return identification number, which you get one through the IRS each year. I am an enrolled agent. Only EAs, CPAs, and lawyers can file business returns. A few years ago, they tried to get all tax return preparers to have some sort of oversight and registration. And so the registered tax return preparer designation was created, which is abbreviated RTRP. However, it was recently vetoed as being the IRS practicing their authority too much by conservative tax court interpretation. Circular 230 was a response that added these additional oversight to try to account for this situation. You may have heard that there are quite a few scams out there ripping people off as the IRS, saying we're going to take you to jail, and people actually believe that. If the IRS is going to contact someone, they're going to send letters, and they are not going to be threatening or anything like that. So it just kind of shows how people have a real disconnect when they think about the IRS versus what the reality of the situation is. Okay, that's all. You can refer to Appendix C for getting started with the TaxAct software, and then there's the assignment in the forum. All right, I'll see you guys next time. Don't hesitate to post questions in the forum, and I look forward to talking to you there or in office hours. Okay.